Hello and welcome to Value Research. I'm Ruchira Singh and joining me today on this special budget edition is Dhirendra Kumar, CEO of our company. Dhirendra, thanks for joining us on this busy day. So people were expecting some kind of a change in personal taxation system. However, what we have been presented is a complete surprise, a parallel taxing system. So what does this really mean for the average taxpayer?
It's quite a change. One is that you are giving taxpayers the option that choose this way or choose this way. You can carry on with the old ways, or you can take a whole new way that here's the lower tax rates, incrementally lower, and up to 15 lakh rupees, and do whatever you want to do with your money. There are merits of this system, and there are some disadvantages of this system. The old tax regime, or the regime, the old way, or I would not say old way, because that still continues. It's not replacing the new system. You can choose. So the first method, so to say, was a great incentive system. If you give incentive for people to save for the long term, it was doing that. But it was too complex. We have just way too many exemptions and other things. So in a way, it was actually the government was playing the role of a guardian. That if you save for the long run in your PPF account, in your EPF account, in this and that, or your mutual fund, people did end up investing, deferring their. So definition of investment is that postponing your consumption. The second method is do whatever you want to. If you want to consume, consume. If you want to invest. But it has no connection with taxes. I think there are merits and demerits of both the system. One is that people can act, the second system, the new system actually works very well for responsible people, for disciplined people. They would like to have no nonsense approach. Give this tax, end of the story, I'll do whatever I do with my money and I can take care of my money well. The first one was, something which was holding your hand, giving you incentive, giving you carrot. So I would say that, and up to 15 lakh rupees, if somebody was, this is our preliminary study, our fund or personal finance people have come up with this calculation. If you make 7.5 lakh rupees and 1.5 lakh rupees is the deduction, ATC deduction, we have taken a very normal assumption of 1.5 lakh rupees and the standard deduction available for that. So in your old regime, or the first system, your taxable income will be 5,50,000 rupee. In the new regime, it will be 750. Your tax liability will be, you will actually be saving more money in the old system. Your tax outflow will be 23,400, whereas in the new regime, it will be 39,000. So, this is actually a benefit of 15,600 in this bracket. Likewise, if you are making 10 lakh rupees and the same assumptions, your tax liability will be 75,000 in the first system, 78,000 rupee in the second system, which is 2,600 rupees disadvantage in the new system. Up to 12.5 lakh rupees, you will benefit from the new system. 2,600 rupee will be your benefit, assuming that you are taking just that 2 lakh rupees benefit. Up to 15 lakh rupees, the benefit becomes the new system is actually the newer system is beneficial. You start benefiting to the tune of 15,600 rupee with all the freedom, no nonsense. Fill up the two things. This is what you earned. This is the tax payable, and it has been paid. End of the story. It actually will take 5 minutes to fill that, your tax return, and 15,600 rupee is the benefit. And that benefit carries on for all subsequent tax slabs. So, because after that you get into the 30% tax bracket. So, I would say that government is finally thinking, by introduction of this, that citizens are responsible people, they can take care of themselves, they don't need to guide them in terms of what they should do with their money. Just pay their taxes.
So clearly some people will be left with more money in their hands. So do you believe that it's going to boost some kind of consumer spending in the economy, which we have been not seeing so far?
I think so. Some people will have greater flexibility, and that flexibility means, and our tax laws assume that your context remains constant all your life. That is not so. When you are young, you need to really, you might be earning less, you might be paying taxes, but your consumption, you just may not be saving anything. As you get older, your income rises and you don't need to spend as much, setting up a home or whatever you're doing. So things change. The new system actually gives you all kind of flexibility. It gives you that, invest when you want to, don't invest when you want to. Your context doesn't really provide you that, consistency that, but tax laws are very regular.
So last year, the government had done something similar for corporate tax. Rates were reduced. However, we did not see much of investment. So now what do you expect people to do? Do you think there might be more spending or saving? And then do you see any anomalies that need to be corrected in this new system?
I think, I don't see any difference as such because, there's no anomaly. We have looked at the finance bill. Things are pretty clear. Take exemption, carry the old way. Don't take exemption, come here. And most of the eligible expenses, all the reimbursement and other things are taken care of. So looks like very well crafted. I would say that it will definitely give boost to people who will, boost to consumption. I think, it is not beneficial to one particular set of people, particularly youngsters who will be doing a lot of, they will be borrowing to spend. This will only accelerate a little bit of that. So, I think this coupled with the need to actually be financially more prudent for the youngster might be, they will be the only people at loss. Otherwise, I don't see, much of a difference, and I think it is good that government doesn't behave like, treating its citizens like a parent.
Right. Now, the DDT, the Dividend Distribution Tax, has been done away with. So, what does this mean for A, savers, and B, retirees?
That is also, as much, government introduced all these things simply because it was incapable of, getting the taxes. As things are becoming, widespread, digitally connected, government knows that, this person got this much of dividend, it can actually backtrack. Income tax returns are getting, entirely digital. One can trace back to each and every rupee which has been paid by a company to an individual, and it is all electronic transfer. You need a PAN card for, being an investor even. So things are quite connected. It is about time, this is a fair system. The earlier system was that this was the flat dividend distribution tax because the government is not competent enough to actually take the tax your income coming by way of dividend. Now, the current thinking looks like is that all income is income. Earn whatever you want to, and you will be taxed depending on your income, overall income. With this in mind, I think this is a very fair system that has happened. If there is a retiree who has a equity portfolio of even 1 crore, and assuming that this is his only investment, and his dividend income is 3.5 lakh rupees a year, that is typically, good companies also. So, if 2, 3%, 4% dividend yield, he will be out of the tax bracket if this is his only income. And he will have capital appreciation which will happen in its own way, and the dividend will keep getting adjusted. In the earlier system, what was happening is that even if it is 4 lakh rupees, dividend distribution tax be levied, and he will be getting less dividend. That was nearly 1/5 of your money. So this is a fair system, and people who have dividend is another stream of income. House property income from that is another, salary is another. So, all your income getting clubbed and being taxed at this marginal tax rate, and you choose the two systems. So, I think, it is empowering investors, and this is where, I think it will benefit the most, the people who need it most.
Right. So, this budget has a bit of a surprise. There's a proposed IPO for LIC.
Yeah.
So do you see the disinvestment strategy of the government having some kind of a change?
Yeah, government has not done something which will actually raise revenues. GST is out of the purview. Corporate tax rate was reduced already. So the only way government could raise resources is sell companies, its assets. And I think it is high time. I think, it's very important that government is thinking in terms of disinvesting LIC. It is one of the most prized assets, largest insurance company with the highest market share, with the biggest asset base built over a long period of time. Effectively, LIC happens to be, it's too big to fail. Bringing in greater transparency, bringing in greater, accountability with a public listing. I think that is another payoff, not just a financial payoff for the government that, shares of LIC, which is in the name of President of India, will now be held by citizens. But primarily, and LIC is one PSU where it doesn't come back to the government for money. It actually bails out, all other companies come back to the government for a bailout, or, if you own the bank, your lending goes bad, and you get back to government for more capital. Oil companies, sometime, you get back to our expansion. Good PSUs don't, but, most other PSUs, of the 240 of them approximately, 100 of them, they just are dependent on the government dole, they are taxpayers' liability. So I think it's high time that, we take, they're thinking in terms of taking LIC public. It should be done with, with a time scale. It should be done with a milestone in terms of, and bringing in accountability, because it's too big to fail. If LIC is in trouble, we Indians are in trouble. So it should be done with some kind of time scale of all else that needs to be done, just not getting the money.
So LIC IPO, will this be the IPO of the year?
It could well be, and it could be one of the biggest IPOs. It will straightway find its way into the big indices, rightly so, the biggest insurance company by a wide margin. My big expectation from LIC will be that LIC has been able to modernize its systems, process, many things over the last 10-15 years, but will it get smarter or so big that it will remain an average? Can it modernize itself further in its approach to business? That I think is needed, and if that comes in the way of LIC, that I think will be an even bigger payoff for the government, that LIC is just not providing some kind of rescue a vehicle to rescue government disinvestment program, but is also a valuable asset which is growing and helping investors, or Indians save and prosper through their with their services.
Right. So we had the success of the PSU bond ETF earlier, and now we have a GSec ETF. So does this have any significant importance for the average saver?
It is, because government bonds, they're the safest, and Indians' flight to safety. In India is dominantly a fixed income country. People, the first thing is how much will I get? Is it guaranteed? And what we have seen in recent times is that the fixed income market has been very turbulent. People for the first time are witnessing some decline in value of their fixed income funds. Getting this, first we had the CPS, Central PSU bond ETF. It succeeded. It was able to raise, nearly 12,000 crore. Safety first is when it comes to fixed income investing, and you can't get higher safety than G6. How will people, reconcile with the move, the declining or rise in value of these ETFs, despite having the highest credit quality, is something which requires education. Because if you invest in these ETFs and tomorrow the interest rates actually go up, these bonds will actually go down in value. When this inverse relationship between a bond and, likewise for the bond ETFs, so if they go down in value, how will people reconcile with it? And but I think it's a good idea. It'll lead to deepening of the fixed income market. It'll give investors another choice. It will not be dependent on somebody running his business efficiently or not that your money is safe. I think the other thing which I look in conjunction is deposits up to 5 lakh rupee is now insured. So that is one more step which is providing the comfort of trust your systems more, and we are providing you this insurance, the Deposit Credit Insurance Guarantee Corporation.
Right.
All your bank deposits.
Last question is, more and more Indians have been waking up to mutual funds and stocks. They're seeing it as a necessity in their portfolio. And of course, at Value Research, stories have been done on this. So all in all, does this budget accelerate the process, or do you see it taking its own pace of growth?
This budget actually doesn't do anything which is specific to equity. In fact, I would say that it's quite neutral on that front. But I would say that there is some side effect of one step that has been taken, that if investors get a choice of allocating their resources themselves, and if they choose to if they choose equity, they'll be much better off. Also, it has suddenly as we are right now, the market is still open and we are discussing this. Most life insurance companies stocks are down 10%. Life insurance companies also provide long-term investment vehicles. They turn out to be expensive, they turn out to be less rewarding, but people gravitate to it because, and the draw is that somebody is locked into a long-term endowment plan or a unit-linked insurance policy because of the tax incentive. Now the market has decoded that this tax incentive may not last for very long, and that is taken. So my sense is that freeing up capital for investors to make a choice over a period of time, investors will make a thoughtful choice, and I think equity and equity funds will find its will have a larger following and more takers.
Right. Thank you very much, Dhirendra. Thank you very much for watching. Do look at our website, this particular one, valueresearchonline.com, where you'll find a lot more stories on the budget that might help you decode what it means for you and also what it means for your investment portfolio. Do keep watching. Thank you very much again. It's goodbye from us.